Hello everyone, welcome to PwC Tax Bite podcast series. Today I have a full room here in my virtual recording studio because I want to talk about the upcoming government elections in Belgium and the tax reform that could come from that. Let me first do a tour de table of my recording studio here. First of all, I have Tim van Zandt with me. Tim is director in our indirect tax team, so he's really the expert on the changes for indirect taxes. Bart van den Bussen, partner in our team, working on reward, everything that relates to benefits for employees and the taxation thereof. Pieter Gilemon, many know Pieter, but it's our true expert in pensions and everything that relates to that. And Jessica de Bels, who is from PwC Legal and who is joining us here today to talk about the legal side of a few things. This being said, so we're going to talk about the new government, the potential reform that will come with it. But the last that I read about is that the government discussions are lengthy, not that easy, and not moving forward very fast at this moment in time. So Bart, maybe, is it really that relevant to already talk about this today?
Thank you, Peter, for having us. An excellent question. Why would it be relevant to talk to this today? That's already because a lot of work has been done over the summer months and even before. And therefore, we believe that the work that has been done might be a starting point for further negotiations. And we are sure, of course, that in this respect, it's always an answer on certain challenges that needs to be addressed. So probably a lot, not all the measures will be again on the table. But what for sure is that certain needs need to be addressed. And first of all, we have, of course, some financial needs need to be addressed. It's, of course, no secret that Belgium faces some financial challenges. So there is a high public debt and there is a need for sustainable public finances. And then, of course, you often come to tax to be part of financing that. We have some EU requirements, some reforms where also tax can play its role. But also more important for our listeners today is, of course, how can you prepare for certain policy changes? And I think that's, important if we can give some guidance to this, some perspective that you already can start thinking, how can it affect me, my business, and how can I prepare for it? Although, of course, nothing is final yet. But again, I think tax will remain on the table, and sooner or later, the tax reform will become reality. So that's why I say it's certainly interesting to listen further to this podcast, Peter.
Yeah, thank you, Bart. So clearly, what's today on the table, the major tax reform and shift will become relevant at some point. So it's indeed good that we dive into it a little bit. Now, I've read the text, the notes that circulate on this. And the other information, it's all quite lengthy. Not sure that everyone in the audience has had the time already to read everything. Maybe, Bart, can you summarize a bit the big building blocks that you see in this major reform?
Yes, and today that's also important. The note is, of course, a bit broader than tax alone. Today we'll focus, of course, part on the tax measure, but also with Jessica, part on the social measures. But if you look at that from that perspective, what are typically the building blocks? If you look at from my own practice, for instance, everything to do with reward is certainly an important element. Certain benefiting kinds will be subject to change. Pension reform is also on the table. Everything to do with social law. Also, because often we talked about tax reform in the context of personal income tax, but also limited corporate tax measures were also on the table. And certainly last but not least, also indirect tax VAT is certainly an important aspect as part of this potential reform.
So there's a lot in there. Let's, and by coincidence, around this table, I have experts in all of these fields. What a coincidence. Let's go through these changes maybe in detail a little bit more. And I must say I was surprised when I saw the expected revenue from the VAT rate changes. Tim, that is really a big change, I see, yeah?
Indeed, Peter. Like also Bart explained, in the super note, we see a sort of a tax shift towards VAT, because the main change in the super note regarding indirect taxes is the harmonization of the reduced VAT rates of 6% and 12% into a new rate of 9%, and that would result in a significant return for the Treasury. For instance, the renovation of private buildings would be subject to 9% instead of the current 6%. The same would be applicable to hotel services, to passenger transport, to the sale of books, to the sale of medicines, as well as to the entrance fees to sport games, theaters, and amusement parks, for instance. On the other hand, for restaurant and catering services, the VAT rate would decrease from 12, the current 12, to 9%. Besides this adjustment, the Supernote does not foresee in a big reform of the existing VAT rates, but there are some specific changes. For instance, the VAT rate for fruit and vegetables would be 0%. The construction and real estate sector, they get a boost because the application of the reduced VAT rate for demolition and reconstruction would be expanded. And finally, there are also some environmental measures, you can call them like that. For instance, the selling of firewood and charcoal would increase to 21%, but on the other hand, the installation of solar panels, of solar water heaters and heat pumps would benefit from the new rate, the new reduced rate of 9%. And in addition to the change of the VAT rates, the Supernote foresees also the importance of invoicing, e-reporting, in order to tackle fraud. And regarding customs and excise, there the Supernota is more vague. There is foreseen in an improvement of the AO status for companies, also in a modernization of the legislation in the interest of the operators, but Peter, without giving further details about it. So that are, in a nutshell, the most important changes for VAT and customs and excise.
Yeah, I think that's true for everything we will say today, and the details will still need to be worked out, but I think it's clear that indirect tax will become a source of funding for the tax reform, and an important one. Then there's a separate block, I think, on pensions. And Peter, what's your view on this? What's the expected impact of this?
Well, there's a couple of items. I think in first instance, we see that the note presents some proposals to boost complementary pensions. And in first instance, the ambition is still there to offer to all employees a pension plan that has at least an employer contribution of 3%. So this means for employers that do not offer such a plan, or a plan that is lower than 3%, this could result in an increase of the personnel cost. The second one that is, for me, very important and very attractive is that under current pension legislation, complementary pensions must be taken out when the statutory pension begins. So if you start your statutory pension after a market crash, the value of the complementary pension could drop a lot. So to avoid that you're forced to cash out your complementary pension at an unfavorable situation, so after a crash, it is proposed in the note to let people choose to delay the payout of their complementary pension until after the start of their statutory pension. So that would be a new measure that is, let's say, avoiding such unfortunate situations. The note also mentions that taking out complementary pensions in the form of an annuity, so a periodical pension payment, should not be tax disadvantages. However, it does not say anything about the tax treatment of a pension lump sum, so a one-shot capital payment. So this raises the question of whether there's an intention to tax periodically paid pensions more favorable in the future, or whether lump sum payments, so pension capitals, might become less tax attractive in the future. That's unclear. The note also includes, let's say, a remarkable proposal to strongly encourage working longer. retirees who want to earn additional money or additional income, so to speak, after a full career of 45 years or after a statutory retirement age, so 65, 66, or 67, depending on the birth date, will pay less tax than they do now, with a tax rate capped at 20%. And it would be a flat tax rate for people earning money after the retirement age or after a full career of 45 years. So that's, I think, the things that boost complementary pensions. The note also includes a couple of proposals that could significantly impact end-of-career planning. On one hand, new inflows would have to stop for the unemployment with allowance scheme. So let's call it the former bridging pension system. The part-time retirement schemes, that's in Dutch, tijdkrediet landingsbaan or crédit en fin de carrière in French. And all other systems that encourage early exit from the labor market would, let's say, for new inflow, come to an end. So, yeah, for employers dealing with too many older employees, such measures could be inconvenient, as the options for, so to speak, gently phasing employees out early would disappear. On the other hand, a flexible retirement age with, they call it an actuarial neutral adjustment, would be introduced. What does that mean? For people that continue to work after 35 years of effective work, and so they continue to work, there would be a pension bonus. So your pension would be increased. On the other hand, if you have your early pension before reaching 35 years of effective work, then there would be what we call in Dutch a malus, which means that there is a decrease of the pension for, let's say, people not coming to 35 years of effective work and taking their pension early. So this means that, yeah, they want to encourage effectively working more than 35 years, and assimilated periods, unemployment and so on, would be less attractive from a pension perspective. I think, Peter, these are the, let's say, main eye catchers. There's more in it, but this is already quite some stuff in the pension landscape.
Yeah, I think it's going to be important indeed for the audience, maybe to reach out also internally and speak with HR departments to flag this. Exactly. Important changes are coming. And that's a little bit, that's very much for impact for the employees. But I think also, Bart, on the side of the personal income tax, and I think a lot of people are wondering, will I have more or less after the reform? But there's a lot in there, I think. Can you explain a little bit what's on the table?
Sure, and indeed, will I have more or less? That's of course the key question, and that it will also be on an individual basis. And here I want to zoom in or tackle it more from a reward perspective, and then we're indeed more in the context of employee-employer. Because of course, as you know, a typical package can exist from a base salary. Some people have additional benefits that Peter just referred to, actually the additional occupational pension scheme, but there are other benefits like a car, a fuel card. Some people have also part of their package is not fixed but variable. So you have an annual bonus on a short-term basis, and even some people are more rewarded on a long-term basis. There are long-term incentive plans. And actually, if we see to the note, there might be changes on each of those big components in the reward package. But of course, if I first look at it from a general perspective, from a personal income tax perspective, not for everybody the same, of course, that's actually what is foreseen. That's not new, a reduction of personal income tax. So by an adjustment of the progressive personal income tax bracket, and also an increase of the tax-free lump sum amount. So that means, of course, that the intention is of this reform that everybody will earn a bit more. And that's actually the starting point. That's also actually reinforced with the intention to abolish a special social security contribution, so which is currently capped at a bit more than 731 euros a year. So that would also be a direct effect. That's, of course, for everybody the same. That's not specific for workers or not. If you look at more again in the context of reward and zooming then on terms of benefits, there's indeed also something mentioned about a change for the fuel cards. And there it's actually indicated that there should be a higher taxation on fuel cards. That's not the same as the actual value, because that's not the wording I found back. But then also just not taxation as a whole, but more related to the private kilometers. So that's certainly, again, something that might change. And again, for employers to see, okay, if that's still worthwhile to offer it, but also more from a practical perspective. If we need to track the private kilometers, how will I do that? And again, is that additional potential administrative burden still worthwhile to offer, for instance, a company car with a fuel card, or will be the future be just a company car without a fuel card? So again, and that's one of, I think, the elements to reflect on from a benefits perspective. And we already had, of course, the pension part. If you remain in the domain of benefits, there would be also changes. And, last few years, there were a lot of new vouchers that popped up. You could have, you have eco vouchers, you have consumption vouchers, you have culture vouchers. And if you compare that with the countries outside Belgium, there's a bit specific Belgium. And there you see that actually the intention is to simplify things, to make sure that certain voucher would be abolished. But again, the meal voucher, which of course the first, or I would say the first voucher, the most well known, that would be further reinforced. So again, from an employer perspective, for which occasion, for instance, I currently give my employees a culture voucher, I should reflect on. Should I replace that? Again, that's more from a reward philosophy perspective. I also mentioned a bonus. There also we have a typical regime in Belgium that's linked to the so-called stock option legislation. There is also in the intention to do a reform. What's there on the table, that typically there would be an additional solidarity contribution introduced. So that's more important from an employer perspective. That would mean that the potential cost price of using of stock options will increase. And there I saw no difference whether there are stock options that are used more in a short-term context, being on the annual bonus to be settled, rather than also typically in long-term incentive plans. Where I do see a difference is actually on to which share the option relates to. And there is a specific reference made that if the options are referred to, or the underlying share is actually a company share, that still the stock option legislation as is, as far as I can read the note, would remain unchanged. So meaning that apart from that additional solidarity contribution, that could be still applied. So especially I think for employers that have long-term incentive plans, that would be still some good news. On the other hand, what we typically see in the short-term incentives of the annual bonus, those are typically options on not employer shares, but typically on investment vehicles that are quoted as well. And there it's actually mentioned the intention to say, okay, that will be taxed actually as cash. So there, I think, again, an employer should see, is it still then interesting to offer another instrument than cash if you know it's taxed on the same basis, because you have also some market risk, etc. Question, it could be an opportunity, again, some changes that could take place. So again, there's a bit in a nutshell, more focusing, Peter, on the reward perspective in the context of employer-employee. It's not exhaustive, but again, that gives some idea that on every component of the reward package, I think some proactive reflection is at this stage, I think, certainly not a nice to have. And then already have, if you need to homework, again, if negotiations start again, then of course that can be fine-tuned further.
Okay, Bart, that's a full package. I think it's the most impactful personal tax reform that I have seen in the past year. So very, very important to monitor. Now, there's also a very important social law part of the reform. And for that, Jessica, I would turn to you. I understand that also from a social law perspective, quite some changes are being proposed in this package.
Yes, indeed. Because indeed, a lot of the focus is going to the tax, and I understand it, of course. But from a social law perspective, there are really, you really see that the political parties are really thinking thoroughly about a a good labor law reform, which is something that we've been pleading for over the last years and that our clients are also really asking for. And when I look at the super note, we can, to summarize it, because it's a lot that's in there, to summarize it, we can distinguish three main pillars. So the first one, which is, Bart already touched upon it, is simplification of a lot of labor law measures. Second is flexibilization of labor law. And third is activation and employability of employees and employability on the labor market. So if you look at the first one, simplification of the labor law, I think we've been saying this a lot, that our labor law is too complex. It's very difficult for both employees and employers to understand. And this super note proposes different measures to tackle that. First of all, as Bert already mentioned, the abolishment of the different checks, for example, but also they want to reduce the number of joint committees. There are measures in there to simplify the procedure for collective dismissal and closures of companies. Also, the different types of thematical leave, such as credit time, etc., those are also going to be reduced. Abolishment of the federal learning account, which will be welcomed by a lot of our clients, I think. But also simplifying the rules on the lending of personnel, which is also something that's really an eyesore for a lot of companies in Belgium. So purely on the simplification part, we can really applaud the fact, regardless of the content, because as I said, it can change, of course, but regardless of the content, that's really something that we're applauding. And the second one as well, the flexibilization, especially in terms of working time. Our Belgian system is pretty tough at the moment if you really want a flexible way of working. Measures that are being proposed are, for example, currently, if you work past 8 o'clock in the evening, then you're doing night work in accordance with Belgian law. This would become midnight, which is something that would really ease the procedures for a lot of companies, since you have to have specific procedures in place to incorporate it in your company. But also the minimum hour threshold will be abolished, or could be abolished. Flexible working times, Sunday work would also become more convenient. So these are really things that we again applaud and would really ease the day-to-day work for a lot of companies. Then in terms of the third pillar, employability and activation in the labor market, this is of course all in framework of the specific goal to reach the 80% employability in the labor market. There we see two main items. First of all, if you have a restructuring, then they want to make sure that more than today, there's a part that focuses on the reintegration of the people into the labor market. I think that's already the case today, but they want to have an enhanced focus on that matter. And then second of all, also, in terms of long-term illness, I think that's something that's been a discussion point with a lot of our clients over the last years. After employees have fallen ill after 1 year that they're out, it's really difficult for a lot of employers to re-engage them back into the workforce. So there's a specific topic in the super note that addresses that fact, to really invest in prevention on the one hand, but also draft action plans to enable that reintegration. And I think that that's a very important and actual topic for our clients as well. So overall, it's a summary, I would say, of what is on the table for social law, but definitely very interesting to see that the cry for help has been heard, and that this is at least being discussed at this time.
And Jessica, you referred a few times to flexibility, and that linked also well to something again more reward related, but again it's often a crossroad also with employment law and social security aspects. There's of course everything to do also with flexible reward, and that is of course something also mentioned in the note as such. because there and a lot of employers have a flexible reward plan, so cafeteria plan cafeteria, because there would be a measure foreseen that going forward, that if you would introduce such plan, that you cannot apply anymore a salary sacrifice. That would mean that you decrease your fixed remuneration to agree for the future, because that's also, I think, the link with employment law and contracts, that you say, okay, we agree a new package for the future. I come to work for a lower monthly salary, but I get some additional benefits in return. So there also, based on what I read, it would not be possible. What is less clear, I would say, is again, if you would do finance it via bonus, it's not the fixed salary. But again, I think, Jessica, there it's very interesting to look at not only from a tax angle, but also from employment law and social security aspects.
Yes, definitely.
And again, Peter, that would be a call to reflect on, because that type of schemes are really, I would say, an ask from employees to make sure that they can individualize more their package, and of course employers use that in the war for talent. So again, it's food for thought to say, okay, can I still offer that plan for the future? How will it be financed if a salary sacrifice is not possible? Is a bonus possible, or other benefits? So that's again, I think, very interesting stuff. So that's just one thing I wanted to add, Peter, from that one.
Yeah, thanks very much, Bart and Jessica. Yeah, and then there is a final part, I think, in the packages, and that has to do with corporate income tax, and that happens to be something that I'm quite interested in. So I want to summarize also a little bit what's in the package there. Now, corporate income tax is not the main piece, if I would say, of the reform, but there are some important measures there. And if I just walk through and pick out a few that I find very interesting, well, one is a simplification of the disallowed expenses. So there is a mentioning that, as it is the case in our surrounding countries, instead of making the detailed calculation of the disallowed expenses in the corporate income tax return, you could go for a lump sum approach. Probably a lump sum approach that will end up a little bit higher than doing the detailed calculation, but I think many of you will agree with me that it's a very time-consuming exercise to define the disallowed expenses. Next to that, also, the participation exemption would be slightly changed. First of all, we would go to an exemption. That will take out a lot of the issues we have from a European law perspective with the deduction element. So it would be rather an exemption, probably a change to the starting position of your reserve table. But on the other hand, the measure would also require that there is a lasting relationship established with the subsidiary. We don't know exactly what it means, but if we look at what has been on the table in the previous years, then probably these measures might aim at reducing the participation exemptions in situations where it is rather an investment. The DB BEVEC likely will be on the table as well. And so there are some important changes there. Also, some changes in the innovation space. Some extensions of the investment deduction would be announced. Some smaller changes to the income innovation deduction regime, but not a lot of details are available on that point. Finally, also important is that there would be changes in the withholding tax regime. Currently, the withholding tax is 30%. That rate would be adjusted to 25%, but with abolishment of a number of regimes like the VVPR bis and some other changes to withholding tax reductions. In addition, the new government wants to increase the strength and the independence of the ruling office, so wants to increase the ability to get legal certainty. It's not really clear what is meant by that, but I think we all agree that this would be a good step if this can be further strengthened and increased, so a stronger ruling office. And there would be some changes to the security account tax. So that would be a source of income for the government. It would be broadening a little bit the basis and the scope of the security tax. So for those who are subject to security tax, I think it's an important measure to keep an eye on what the scope change will do. So corporate tax is not the main aspect, but there's still an important piece of corporate tax measures here included. Now, that brings me also a bit to the question. We have now spent time to explain to the audience all the different measures. Okay, the government will negotiate and hopefully we will have soon a government. I think that's good for Belgium. However, what does it mean? If you are in the shoes of the audience, what do you do with this? What if, Bart? And maybe that's something you want to say something on.
Sure, Peter. And I think my recommendation is always it's better to anticipate than just being too late or waiting. So because you could look at things to say, okay, nothing is final. Things are on or off the table. When it will restart, when will they land? Of course, a lot of uncertainty. That's for clear. So a first reaction could be, okay, nothing is decided yet. So I don't do anything. But for me, I would not recommend that. That would be a short vision because in the end, we take it as a reality. As said in the beginning of this podcast, there are a lot of challenges we have as a society, as a country. And that likely the tax system will have to change. So the tax reform will come and it will have an impact. So in that respect, I think do some what-if analysis. As I refer to reflect how will my employees be affected? Should I revamp my reward strategy for what I want to remunerate my employees? So I think there's a lot of questions of work already that can be done. So that would be my recommendation, Peter, in this respect.
Yeah, so anticipating what the impact of the changes will be. Jessica, you look at things more from a legal perspective, of course. Is that also how you look at this? Do you agree?
Actually, I completely concur with Bart. Of course, as already indicated several times, nothing is final. We don't know the details, but doing some scenario planning on the items where you feel that your company would be impacted the most just makes sense. The measures, if they would become reality, it won't be in 10 years. So perhaps just do some scenario planning just to make sure that you know where your sore spots are in light of the proposed reforms. And then I think you are well prepared for any changes that come ahead.
Yep. Okay. Well, sounds like a very good recommendation. And I think that also brings us to the end of this podcast. I think it's also important for the audience to not only keep an eye on Belgium, but the broader changes that are happening. There is an important election upcoming in the United States. The candidates have presented also their tax policy now, and we see some important differences there. We don't have time to go into details in this podcast, but we will provide more details on that at another occasion. But also in various European countries, we see governments, new measures, etc. So it's important to keep an eye. Follow our news alerts of PwC so we can keep you posted on the changes that come. With that, I would like to thank the audience, first of all, to tune in my podcast, and also the speakers here to share their views on that. Have a good day.
Thank you.
Bye-bye.
Bye.